All right. So sorry about that. We have kind of a short break here if you want to remain on schedule. So we are going live with our last presentation of the day. So our speaker for that last presentation will be Christopher Thom from Autumn Brown. So Christopher is a portfolio manager at Autumn Brown Limited. His investment philosophy is based on the principle of value investing. He builds portfolios around the individual needs of his client using a variety of investment tools. And a growing part of his investment strategy for client is the use of options. So prior to joining Alden Brown Limited, he spent several years working for a Fortune 500 company based out of Cincinnati, Ohio. He studied engineering and business at Simon Fraser University for 2 years and received a diploma of technology in marketing and sales from BCIT. He also recently achieved the Canadian Investment Manager, Derivative Market Specialist, and also Fellow of Canadian Security Institute designations. He has made numerous guest appearances on Business News Network or BNN and also with us on multiple occasions on Option Education Days. So Chris will now present a three-step process on how to build and protect an equity portfolio with options. You will learn on how to acquire stock using cash secured put, generate income with covered call strategy, and finally protect your investment with put options. So Chris, the floor is yours.
Thank you. Not sure if that background is too bright or if we're okay. Um, yeah, so thanks everybody for tuning in today. Look forward to talking a little bit about sort of building a portfolio, generating income with it, and then protecting it. Want to try to get through my presentation, in 30, 35 minutes to open it up for the, I guess we're having some video issues here. I'm going to turn the video off for a second here. Everybody knows what I look like now. How to build a portfolio, how to generate some income from that, and then how to protect it headed into some times of volatility or some currency hedging. So I want to try to answer as many questions as I can. So please put the questions in throughout, and we'll compile them and try to get them at the end. If your email address is in there, anybody that we miss during the presentation, we will reach out after, because schedule's a little bit clearer these days with no vacations, no kids sports, no nothing going on, so we're able to get back to everybody. So a couple disclaimers. So as I said, I'm going to start by talking about how to acquire stocks by selling a cash covered put, generating income on shares that are held within a portfolio, and then how to protect your shares by using some put option strategies. So just a quick little blurb about Autumn Brown. We are a BC-based investment firm. We're totally independent, so we're not bank-owned or bank-affiliated. We have about $14 billion under management, and we're 6 offices in BC, but we do operate nationwide. So we've got clients all across the country. A bit about myself. I've been working at Autumn Brown, been an advisor since 2008. I'm a derivatives market specialist. I think he already mentioned I've been on BNN and done TMX events a number of times. And as a portfolio manager, I implement the day-to-day discretionary strategies for clients. So many options clients out there start doing it themselves. It may become a little bit too onerous. They like the strategies. It's just not something that they want to be doing day to day. So they turn it over to me. We come up with the strategies that we want to do, and I execute the day to day. And a big thing that I try to focus on is really simplifying options trading. So I leave it to the other guys to use big words like delta and vega and things like that. I'm not usually looking at too much of that, looking at building structures that aren't too reliant. So as I said, we're going to do cover three main areas. First one, just acquiring stocks, generating income, and then hedging downside risk. And that hedging that we're going to be looking at is going to be both hedging equities, but also currency. So first, I really want everybody to remember one thing here. I'm going to be talking about some different concepts. You guys have been learning a lot throughout the day here, but we are not reinventing the wheel. Everything here are existing strategies. I try to make it as simple to understand so that people can actually go out and execute it. I think there's a lot of stuff in the options world that definitely can get a little bit too complicated, so people like the idea, but then they don't wind up executing it. So the first thing we'll look at, selling a cash covered put. What is it? What's the process for executing? And what do we do at expiry? So it's one thing to talk about how we're going to put these things on, but it's another thing to look at what we're going to do as time goes on. So what is a cash covered put? Basically, it means that we're going to sell a put. We have the cash on hand to buy the stock if the shares decline in price and we're forced to buy it. So an example of that is we sell one $50 put option. We have $5,000 earmarked to buy that stock. So 100 shares times $50 a share, $5,000. So we're not using leverage. So I'm not going to have $100,000 on hand and then sell an underlying value of $200,000 of equities, because if those stocks decline, then I'm not going to have the cash to buy them. And I want to make sure that I'm using this as a tool to build a portfolio. So this is used alongside, just a standard strategy of buying stocks and holding them. So what's the process? First, you find a stock that you want to own for the long term. So that's the most important thing. You need to be finding businesses that you want to own in a stock portfolio for a long period of time. Do not get lured in by big premium, okay? There's definitely times out there where a person's looking at the market and looking for opportunities, and they see, hey, that implied volatility on that stock is pretty high, and pretty attracted to this position. You know what? I'm going to go ahead and sell that put to take advantage of it. But as they say, sometimes the juice looks sweet, but it winds up being sour. So sometimes there's an underlying reason that you don't know as to why that implied volatility is so high. The next thing to do is to look at the timeline. So downside protection, how much distance between here and where the stock is trading and where the strike price is. A timeline, a lot of times we want to look at having an event between now and when that option expires. And then taking a look at that implied volatility. And then finally, we're going to go out, we're going to execute that trade. So when we're looking at downside protection, how much room do you need or want between where the stock is now and the strike? So a pretty simple way to look at that is a lot of times people will say, this stock's trading at $55. If it gets back down to 50, then I'll buy it. Well, selling a cash covered put is a great way to execute that strategy now rather than waiting for that stock to decline. In that situation, I would say, okay, I want to sell that $50 put because that's where I want to be picking up this stock. So timeline, how long until expiry? Is this something that I'm doing I'm selling the put over the next month, or is this a lower volatility name that I'm going out 6 months or even a year? And what events are happening between now and expiry? So a lot of times, you as I mentioned, you want to straddle that earnings announcement. Implied volatility is typically higher when there's uncertainty. If there is an earnings announcment that's happening, that carries with it uncertainty, and with it you'll have an elevated implied volatility, so you'll typically get paid more. Then the next thing is we're taking a portfolio approach with this. So we want to have a mix of expiries in the portfolio. You don't want to say, okay, I'm starting to build a portfolio right now. We sell a whole bunch of June puts. The market declines between now and June, and you wind up strapping on a whole bunch of stock. And you want to have that staggered timeline, just like you want to have a mix of equities in a portfolio. You want to have a mix of expiries as well. And then the last thing is looking at the implied volatility. Are you being compensated for selling this insurance? are you getting enough premium for this? You want to make sure that you're getting value for the trade that you're executing. So that's really important to take a look at what that implied volatility is and maybe compare it with historical volatility on the stock. So how many contracts should you sell? First, you got to determine your position size. Let's say you have a $200,000 portfolio and you want a $10,000 position for this particular equity. We take $10,000, divide it by the strike price, and then divide it by 100 shares, and that'll give you the number of contracts. So the example I use here, $200,000 portfolio, 10,000 divided by $50 strike, and 100 shares is 2 contracts. I'll get to questions at the end here, but I do see one about can we sell these in an RSP? And no, you cannot sell puts in an RSP. It'd be a webinar for a different day, but selling a synthetic put by buying a stock and selling it in the money call. But again, that's for a different day. So at the end, and this is where it really matters, you know, it's one thing to see what things look like at the start when you put the position on, but it's another thing to see what to do at the end. So first scenario, share price finishes above that strike. So if I sold a $50 put and the stock's over $50, I'm going to look to sell a new put further out and just do the trade all over again. The first is the share price finishes below the strike. Option 1 is to take delivery. The stock will automatically be purchased. And then at this point now I own the stock and I'm probably going to look to sell a call to start to generate some income on that. The third scenario is the share price finishes below the strike price, so they're in the money, and rather than take delivery of the stock, I want to roll that option out. So what that means is on or near the expiry day, I'm going to buy back that current option, typically for just very close to just that intrinsic value because there's not much time left. So I'll be able to pay just the intrinsic and then sell a new put out further to generate a credit so that I'm able to maintain the same liability as far as what my exposure is, but I'm able to generate some additional income. You definitely want to be entering these as spread orders. So what that means is you're putting it in and the buy and sell happen simultaneously, and you're putting the order in as what your desired credit is. So I'm going to buy back this option, sell a further dated option for a $1 credit as an example. And then it's fairly irrelevant what the 2 options sell for, just as long as the one you're selling winds up being $1 more than the one that you're buying back. So looking at real world example, stocks trading at $55 today, we sell a June $50 put for $3. So those 3 scenarios I just outlined, the first one, the stock's above $50. We made a 6% return because those options expire worthless. And now we're going to look to do that again. Second one, stock is below $50, but because we collected that $3, our net purchase price is $47. So that's a 14.5% discount below that $55 strike, or sorry, where the stock was trading initially. And that's the type of downside protection I want to have in a volatile market. The third scenario would be the stock is below $50, let's say at 48, we buy back the put for 2 and sell, as just another theoretical example, in August put for $5, and it's going to generate an additional $3 in premium for us. So now we own some stock. It's been put to us, and we are going to look to generate some income on that by selling a covered call. So I'm sure it's been explained probably a few times today, but in an options transaction, there's a buyer and a seller. One person's buying premium for some reason or another. They want some leverage, they see some upside, or they just don't have the capital for it to buy the stock outright. And then there's the seller. So this person's collecting the premium. This is who I want to be. I want to sell people that that option, generate that premium as a source of income. So the process for this is first we need to acquire shares in a stock. So whether that's outright buying them or selling puts and getting assigned on those, but I need to own the stock. Now this is a strategy that is available in registered accounts. You can do it in RSPs and TFSAs, no problem. So I've got the stock. now I need to pick a date and strike that suits my needs. So the things that I'm going to look at when deciding what to sell are how much run room I have, so how much room between where the stock is now and where that strike price is. Timeline, again, looking at upcoming events, whether there's earnings or dividends, because dividend payments will sort of weigh on that option premium. And then again, that implied volatility. I want to make sure that I'm being compensated for selling this. I don't want to sell somebody a whole bunch of leverage and upside and not really get much out of it from myself. So run room, I mentioned, this is just the distance between here and what that strike is. You have to decide for yourself, am I comfortable selling at that price? Just like we want to make sure we're selling cash covered puts on stocks that we want to own, we also want to sell calls at levels that we're okay selling stock. Can make a person very sad when they sell a covered call and then the stock rallies. So they picked a name that was undervalued. They did everything right from an equity standpoint, and then they sell that call and it gets called away. And yes, sadness is definitely the emotion that can be felt from time to time. So looking at the timeline and upcoming events. So earnings, almost always want to try to sell a covered call straddling an earnings announcement because that premium is going to be higher. I mentioned that dividends can weigh on the option premium that's collected. So if I own the stock, I will collect that dividend. So if there's going to be a 75-cent dividend, as an example, coming for the next quarter, that gets calculated into the value of the option today because it's going to weigh on the price of the stock because the money's leaving the business and headed out to shareholders. So you'll, in many cases, if there's a dividend between now and when that option expires, you're going to get paid a little bit less. And the last one is implied volatility. So I want to try to generate as much implied vol as I can in the premium that I'm selling. So what to do at expiry? Again, this is where it really counts. Anybody can sell a covered call, but how are they going to deal with it when the stock is at expiry? So first scenario, the shares are trading below that strike price. In this case, the option expires worthless. We keep that entire premium. That is our gain from selling the call. And now we're going to look at doing it again. Maybe it's at the same strike price, and maybe it's at a different one. In a perfect world scenario, we sell a call option, the stock rallies right up to 2 cents below that strike price and expires worthless, and then we can ratchet that strike price higher for the new call that we're selling. Or if the stock has declined, we don't have to be married to that initial strike price that we sold, and we can look to sell at a lower strike. The second scenario is that shares are trading above the strike price. So here we can let the stock get called away and now look to sell a cash covered put to reestablish the position. Or we can roll this just like we did with the put by buying back the call and selling a new one. Again, this can be done at the same strike or potentially at a higher one. So look at a couple of examples. So if the stock's trading at $50 today, and we sell a June 55 call for $2, we'll assume there's no dividend in here. Here's the scenarios at expiry. Stock's under 50 bucks. We sold the $2. It expires worthless. We made our 4% in a couple of months, and now we look to do it again. Second one, the stock is above 55, and we let it get called away. Our net gain is going to be 14%, which is the $5 gain in the stock plus the $2 that we collected in the option premium, 14% for that time period. Now we'll look to do that again. Or the third scenario here is the stock's above $55, and we'll say 57 as the example, and we look to buy that back for just its intrinsic value or very close to it because we're doing this at or near expiry. So if the stock's 57, we can buy that back for $2 and sell a new one. We'll use August as the example for $4, and now we've collected an additional $2. The other thing that we can do is if the stock's trading at that $57 level for the example, we can look to buy that back for $2 and now move the strike up higher. So Obviously, if we're buying an equity, it's because we like the long-term prospects of growth for that equity. So it doesn't necessarily make sense for us to be stuck at one strike price in perpetuity. So we want to own this stock that we think will have, X percentage of growth per year for a number of years. So we want to move that strike up with the stock. So I mentioned the perfect world scenario. If we sold this $55 call, would be that it finishes at $54.99. But if it's at 57, we may look to buy that back and move the strike up. And I try to do these without spending too much money. So here, if we moved it up to 60, we'll say that $60 call out to August, we could sell for $2, which is the same price that we'd be buying the initial call back for. So it's done at even money, but it gives us an additional $5 for the stock to move higher. And this is really better aligned with a long-term investing strategy. Okay, so I hope I'm not blasting through all this too quickly. I hope everybody's keeping pace here, and I'm not steamrolling everyone by motor mouthing here, but I want to take a look at some hedging situations. So this is where the market has been a lot more volatile, and this is the types of calls that that people are getting with their advisors. They say, I'm worried about the market. Don't worry about it. You can't time the market. There's no alternative to stocks. These are the types of messages that we're told as investors. And when we're looking at hedging, timing the market is not a good long-term strategy. It's impossible to do over the long term. Anyone who says they've figured it out is probably not being accurate. It's just too difficult. The other thing is not everybody's got the same runway to recover. So if I own some really good quality businesses and they decline in value because there's a market decline, well, if I have 20 years in order for those to recover, that's okay. I can take that risk of being in the equity market. But if I'm further along in my investing runway, then I may not be able to carry those same equity risks. So I want to have a way to hedge some of that. The other thing is right now with interest rates as low as they are, is it's almost like you're either in or you're out. You're either in the equity market, you have an opportunity for growth, or you're out of the equity market and you're happy with a sub 2% return because, with short-term and long-term interest rates as low as they are, there isn't that sort of safety net where people can just say, you know what, I'm going to buy bonds and I'll get my 4 or 5% return with a much lower risk. That just doesn't really exist at this stage. So having a way to expose yourself to equities without having all of that same risk is a good strategy. So there's three main scenarios or types of hedging that people do. The first one is catastrophic. The second is immediate. And the third is currency. So catastrophic, this would be hedges against massive declines in the market. This is what you would want if you are, someone who just says, look, I can take some equity risk, but I just can't handle 2008 all over again. These can typically be low cost, and I don't spend a lot of time on this because often, if you really want that catastrophic insurance, you just buy a deep out of the money put and try to do it as cheaply as possible. The next is immediate. So this is a hedge that starts working right away. So this is for shallower pullbacks. But the one thing to think about big pullbacks versus small pullbacks is if the market drops 20%, will it drop 10% first? So if I want to hedge something, I typically want to hedge that first 10% because that's going to be kicking in as soon as the market starts to decline. So I don't, even if I only hedge down 10%, but the market drops 20, well, I'm 10% ahead of the game because I had that immediate hedge. So this is where I like to spend most of my time discussing and executing for clients. The third is currency. So for these, we're talking about US dollar using USX options. It's a Montreal Exchange product. It's a very simple to execute. Each contract is $10,000 US. So the underlying is always the same, 10,000 US dollars. They're great because they're a European option. So if I'm short some of these, I don't have to worry about being assigned early because they can only be assigned at the end. And they're also cash settled. So again, I don't have to worry about closing these or taking delivery of a bunch of US dollars. These things are great because they're just so simple. So the main strategy I like to do is buy a put spread and sell a call to help pay for that. So the three pieces of this are by finding typically an index option that is closely correlated to the portfolio that I'm holding. So I buy a put near or at the money, sell a lower strike put to reduce that. So there's my put spread. And then because I really don't want to pay too much for these things, I sell an out of the money call to further reduce the cost. So the nice thing when you're in a volatile market like we're in now is the option prices are higher. So things that are further out of the money, you're getting a much higher implied volatility. So in this scenario, I'm buying one option. So I'm paying premium to one person, or I typically say a person, but I'm paying one for one strike, one option that I'm buying, and then I'm selling two. Okay, so I've got two options decaying that are away from where the stock is now, that are further out of the money, for just the one that I have decaying. So here's an example. Obviously, the market has moved up from when I put this presentation together a couple of weeks ago. So this data is from April 8th. So in this scenario, XIU, which is the TSX 60 ETF, was trading at $21.40. I want to go out to September. I buy a $21 put for $1.85. So that's me outlaying money. Against that, I'm going to sell a September 18.5 put. So this is a $2.50 wide put spread. And I'm going to sell that for $1.12. So that leaves me paying 73 cents. And 73 cents is about 3 and a bit percent. That's too much money, in my opinion, to be hedging out that time frame, because I'm paying 73 cents for something that's worth a maximum of $2.50. So again, only about a third of that. This is an elevated volatility time period. So I want to pay for that more. So I'm going to sell a 23.50 call out to September. So this is a situation when you are saying, I think the market's going to go down. So you shouldn't be too fearful of selling that upside call, because it doesn't make sense to be fearful the market will fall, but also fearful that it's going to really rally. So this is a situation where now we're going to be hedging as soon as that stock drops more than 2%. So looking at the pricing of this, we're paying a net of that $1.85 minus $1.12 minus 57 cents is 16 cents in total to put this on. So if I have a $214,000 portfolio, this is going to cost $1,600, which now is only about 0.7% of the overall portfolio, which hedging that out 5 months seems a lot more reasonable to me. So let's look at some scenarios. Here I have $1 million portfolio. I put this structure on because that 1850 was 12% below where the stock is trading right now. So at a 12% decline in the market, that $1 million portfolio, if it's perfectly correlated, drops from $1 million to $880,000. But now my put spreads, I've got 120 of them, or sorry, 100 of them now worth $120,000 total. So my net value is I've got my stock portfolio plus that option hedge nets me out at $1 million. So I've broken even. So my market outperformance with this scenario is 12%. So here, if we see a 20% decline in stock, so here we're getting more towards a catastrophic decline. Now that equity portfolio that was worth $1 million is now worth $800,000. And my option position is worth $120,000. So my overall portfolio is the $800,000 plus the 120 is $920,000. So I'm down 8%. That doesn't feel very good, but I'm down 8% in an environment that's down 20. So my market outperformance and my relative position is 12% better off. So this is we've done well. We didn't need to hedge all the way down to 20 in order to outperform the market. So the downside of this is if the market really rallies. So we are definitely selling away some upside. So let's picture a 15% increase in the stock market. So the market rallies, and now that portfolio is worth 1,115,000, and our option position is worth negative 50,000. So our net return, because we sold that 10% higher strike, I guess I didn't lay out all of the math on these things, but when the stock was $21.40, that $23.50 strike call that we sold was 10% higher. And so my market underperformance is going to be 5%. So here I've still gained 10%. I stayed in the market. So this is the difference between having the ability to hedge and not hedging. If I was worried about the market and I did not use a tool like this, I would have sold my stocks and watched the market rally and not participated at all. Here, I participated to the tune of 10%, and now I can look to do this again, right? Just at that higher level. It keeps you in the market and keeps you active and invested in these positions. The other thing it helps you avoid doing is triggering a lot of capital gains. If you've held a lot of stocks for a long time and you really become nervous about the market, you don't necessarily want to be triggering a bunch of capital gains and reaping the tax consequences in order to protect your portfolio. So currency. So this here, again, if we own some US denominated equities, or we want to be buying some, or have US bond funds, or we have just some US cash that we don't want to convert, we can hedge that currency risk out using those USX options. So I guess I've explained it's good for portfolios that are largely denominated in US, or if you're now looking at some opportunities in the US and you don't enjoy paying $1.40 to buy a US dollar, this gives you an opportunity to hedge out some of that risk if the equities do well but the currency declines in value. So we'll look at an example of this. You own 100,000 US dollars, or you have 100,000 US exposure through a mix of stocks, bonds, cash, whatever. Again, this data is from April 8th, but I think the currency is in about the same place. We'll say it's just over $1.40. So in this instance, we know that every contract of USX is 10,000 US dollars. So I'm going to use 10 contracts of USX to hedge out this 100,000. So here, I'll go out to December, and I'm going to buy 10 of the USX 140 puts for $3.44. And then I'm going to sell the 140 call, which I didn't make these numbers up. It just so happened that the midpoints were the exact same number when I did this. Selling that 140 call for $3.44. So I'm doing this for even money. So I lay out nothing. At expiry, if it's below 140, I will receive a credit of whatever that's worth. Because these are cash settled, I'm not going to get delivered a bunch of US dollars or need to hand USD over. They're Canadian dollar settled. And if it's above, that money is going to be taken out of my account. So no matter what happens to that exchange rate, I'm pegged at 140 for that 100,000 USD for the duration of that trade. So I think I got through that in pretty record time. So if there's been some questions that have been compiled, or if anybody's got some questions that they want to start putting out there, I'm happy to take those.
So thank you very much, Chris, for that presentation. So if you are willing to open up the pit for Q&A, please send your question right now in the chat, and Chris will have some time to answer these questions before the end of the day. So.
Okay, so I have the one question I'm seeing right here is can I go over the FX hedge again? I'll back it up a bit here. So I want to, wherever the currency is trading right now, I want to basically set up a trade that makes money if the currency declines in value, and effectively loses money if it increases in value. And the reason why I'm going to do that is because I don't want to pay for it. I don't want to just pay $3.44 for that put. I want somebody to help me pay for that, so I'm going to sell the other side of that. So here in this scenario, if we look at an outcome, if let's just say $1 US at expiry is going to cost me $1.30, then each of those 10 USX puts is going to be worth $10. And that's going to work out to 10,000 Canadian dollars that will be put into my account, because my USD is now worth less in Canadian dollars. So my hedge is going to pay me for that decline in value of the equities. I hope that answers the question. So just looking at the, again, I think it's, I see Ken, you got a question about how to do an equivalent cash covered put in a registered account. Effectively, if you buy a stock and sell an in the money call, you wind up with the same outcome as just selling a cash covered put. So let's say a stock is trading at $50 and I sell a $30 call option. Well, if that stock stays above $50, I'm going to get called away and I will no longer have my stock. If the stock declines below $30, that call that I sold is going to expire worthless and I will not be called away. So I will maintain my stock. It's the exact same as if I did not own the stock and I sold a $30 put. If the stock stays above 30, the option expires worthless. I do not get the stock. And then if it goes below 30, then I'll be assigned. So my outcomes are the same. And the thing that I remember when I first started, looking at options in 2008, the thing that I found so fascinating was how all of these factors that come into option pricing, they're all there, all the different interest rates between the two currencies, and how the option premium, everything always winds up adding up. And if there wasn't, then the markets would be more inefficient and there'd be arbitrage opportunities everywhere. But what you'll often see when we're in these environments where there's interest rates are at or near zero, the amount of time value in the money call versus an out of the money put, at the same strike, if the stock doesn't pay a dividend, is the same. And it's kind of like magic. Well, it's not magic. In fact, I think somebody got in trouble for saying something was magic a little while ago. So I'm going to retract that, saying it was magic. It's quite interesting. You cannot sell a cash covered put in a registered account. But that synthetic put that I just mentioned is doable in a registered account. Yeah, I mean, so again, just sort of looking at, I mentioned it a bit at the start, sort of where I often come into play for people is options are a big part of my business. And so a lot of times people start doing option trading on their own, and they are, like the idea of selling puts and selling calls, and sometimes it can be a bit more of a full-time job than they're interested in executing. And so they come to an advisor like myself who will decide on what types of strategies we're going to use. We'll put the capital out there, and then I execute the day-to-day on a discretionary basis, and we check in as often as the client is interested in having me check in with them on what we're up to, what trades we're doing, how much premium we're generating, and all of these sorts of things. So with regards to USX, there is not a stock. USX is just the symbol, and the underlying is US dollars, is 10,000 US dollars. One thing to think about with these USX options as well is from time to time, you'll look at it and think the spread might be a little bit wide, but the the liquidity behind those is actually fantastic. The liquidity for options is often determined by the liquidity of the underlying, and the underlying for this is the US dollar, which is the most liquid thing on the planet. So I would definitely try to put orders in close to the midpoint, or if you're doing spreads, you're able to decide how much you think the market maker should have and put that in with the desired debit or credit. Trying to see. So I think somebody asked a question about if you sell a cash covered put and it goes to zero, then that's probably a situation you were. So if you sell an uncovered put and the stock goes to zero, what then? So in that situation, you, I think, might have been lured in by some big premium where people were willing to spend a lot of money to bet something would go all the way to zero. And then it did. So at this stage, you would wind up taking delivery and you'd have a defunct security in the account. So that's your worst case scenario. And that's absolutely something that we're trying to avoid. And that's why the first thing you look at when you're deciding what to sell a cash covered put on is, do I want to own this stock for the long term? Question is, in selling an option when the stock goes to the strike price, does the transaction of the shares and stock execute automatically? Is it possible that we don't get called away even if the stock is at the strike price? It will happen automatically because your brokerage will put that trade through. And yes, it is possible that it won't execute, but that would be because whoever bought those options had the right but not the obligation to buy or sell those shares. And so they would have put in a request to not exercise those. So sometimes you'll see at expiry, a stock is trading right around where, right around that strike price. And, right in the last 2 seconds of the day, it might move 5 cents and wind up on the wrong side, where now if a person's going to be paying commission and they bought that $55 call as an example, and now it's trading at 55.01, well, they didn't really want to buy that stock. They wanted to have leverage with the option. So they may request to not exercise it, but that's not usually a risk that I'll take, that somebody won't exercise it. Because somebody has to actually take action for that to not get exercised. So I see, Arthur, you had a question about synthetic put. I went through it a couple times. If you want to send in your email, I can go through that to you later. If anybody has other questions after this, like I said, I'm happy to take emails and questions from people at any time. If you've got questions about some of the stuff that we talked about here, or some other subjects that come up regarding options, options are my passion. And I think this is, we didn't get a chance to get to everybody in here. And so please don't hesitate to either provide your email and I'll follow up, or send an email. So I see Jay, question with the currency example, call and put is the same. How do you make any money? So the thing is here with hedging is another thing that's important to think about is we're not trying to make money with these hedges, okay? In order for these things to make money, we would need to be speculating on the opposite direction of what we currently own. A hedge is merely meant to reduce the risk of a current position. So with that scenario, it wouldn't make money. If the stock goes, if the US dollar weakens, my existing USD position would go down in value, but my option position would go up in value. I'm long those puts, and so the value of those puts increases when the value of the US dollar declines. Same thing on the other side. If the US dollar strengthens, my position is going to increase in value, and my option position is going to decline in value. So they will offset each other, and that's the thing, is a hedge is not intended to make money, it's intended to reduce risk. So if I'm able to have a hedge position that I've put on, and the hedge itself loses money, then as long as I've done things correctly, and there's good correlation between the assets that I'm trying to hedge and the tool that I'm using to do it, I almost want my hedges to expire worthless. It's just like if you buy insurance on your house, you're probably hoping that you never have to use it. So one person asked about if we provide services to provinces other than BC. Yes, we are licensed all across the country. I've got clients all over Canada, and so not an issue to deal with people anywhere else in Canada.
Hey, Chris, do you
Yeah.
want to answer one last question so we can close that up and answer people to through email for the last question that we have, because it seems like the questions are still flowing and
Yeah. Yeah, you know what? I'll end it there. My assistant So Young just sent out a message. So my email, cthom@aldenbrown.com. Any questions you've got, please feel free to reach out. You know, as I said, there's nothing I like talking about more than options. So always happy to have a discussion. Appreciate everybody dialing in today, and I hope everyone learned something from my portion. But I'll turn it back over to the exchange.
all right.